When it comes to creating wealth, the first thought that people have in mind is bank fixed deposits. This is because of the fear that we should not lose our hard earned money. And one more important reason is that it is assumed that banks will take care of our money and help grow it. This belief is now slowly getting faded because of the defaults that banks have been having of late. And along with that, the FRDI bill asking depositors to take a decision on their own about the worthiness of the bank to pay back their deposits.
Fixed deposit on an average has given 5.50% return per annum in the last 20 years. The average inflation in the last 20 years was at 5.70%. Returns earned from FDs did not even meet inflation rates, and upon that, taxes were to be paid on these earnings.
After fixed deposits, the next asset people mostly invested was gold. Women folk always adored gold, and its accessibility in physical form was also one of the reasons where even lower income groups had it as one of their top saving asset.
Gold has given 8.4% returns per annum in the last 20 years. This return was fairly higher than the inflation rate, and it was because of the big move that gold had in the last decade. Gold goes through a 25-year cycle. The next upcycle should begin from 2025. Till that time, gold will stay at current prices.
The next asset that people thought of is real estate. It comes from the necessity that every family should at least have one house of their own. Many people not being able to afford a home of their own in their early part of their life cycle brought an opportunity to take real estate as an income producing asset too. Again, this asset had a big growth in the last decade due to the huge shift in our population from rural to urban areas seeking income opportunities. Again, here the cycle is now reversing. There are many affluent families who have decided to move away from the crowd, chaos, and pollution in the urban areas to peaceful living in the rural by owning a farmland or at least a lot of space and good greeneries around. Real estate returns in the last 20 years have been 6.2%. Again, not very impressive. People rarely think about investing in one of the best asset class, that is equities. This is because of the fear that they will lose their money or terming it as high risk. I would rather say that it is not risk that is prominent here. It is the volatility of the asset, and most important is that the prices of this asset is available every day, which makes people fearful and take wrong decisions when they see some losses in their investment due to prices going down. If, like any other asset, prices were not readily available to people, chances are that the fear of losing in this asset would not have been there. Equities have given a return of 12.90% per annum in the last 20 years, which is more than double when compared to all other asset classes that we have talked about. And along with that, it also has the lowest tax impact, which is another added advantage for this asset. Let's look at how a lakh of rupees invested into all these four assets 20 years back would have fared. This table here shows the growth achieved in each asset class in the last 20 years. When we look at the percentages alone, it shows only a very small difference, while the actual gain made in value terms goes on to be substantial in equities. It is more than 5 times of bank FDs, more than 3 times of what real estate had given as returns, and more than double the returns of what gold has given in the last 20 years. Along with this, one more advantage that equity has is that it can be taken for generating regular monthly income too, like how we have rental income received by letting out a property. And along with the monthly income, you will also have high appreciation in this asset. Let's look at this advantage of monthly income with an example. If we had invested in a house that cost 30 lakhs 20 years back and it was let out on a monthly rent of 10,000 per month, this rent gets increased by 5% with every passing year,
which now stands at 25,100 per month on the 20th year. Total rental income earned for the whole of 20 years is 39.50 lakhs. After 20 years, the property value is now 1 crore. The same investment of 30 lakhs, if done in a mutual fund with a monthly drawing of 10,000 per month, increased by 5% every passing year, you get the same 39.50 lakhs payout, while the value of the investment on the 20th year is 2.07 crores.
Not only the total value has increased by more than 100%, there are further advantages too. Rental income gets taxed on your slab. You need to pay property taxes. Maintenance of the property is another expense, and when the property is sold, capital gains tax has to be paid after effecting indexation. Whereas in equities, only the profits get taxed at a fixed rate of 10%. This brings further gains to the equity asset. The final realized value on the 20th year for both the assets after paying taxes will be as follows.
Real estate investment, after having had 39.50 lakhs of rental income in the last 20 years, has a final sale value of 79.75 lakhs after paying taxes. In mutual funds, after having the same 39.50 lakhs of drawings in the last 20 years, same as what we had in the real estate investment, the final sale value comes to 1.90 crores after paying taxes.
So, by all means, equity is at a far advantage position against all other asset classes. In rental, we still have further expenses like property can be vacant, which will not be giving income. Building may need maintenance, and many a times tenant will end up a problem creator. And when we go for selling a property, finding a buyer is not so very easy for a immobile property. In a financial asset, no such hassles are there. All the income comes direct to your bank. You can sit happily, relaxed, and enjoy your returns. Thank you.